Hi everyone. I wanted to do a quick video about investing and particularly about the market ups and downs. I often hear, help, the market's down. Should I withdraw all my money? This is another great example of how our emotions can override any logic or math. So in order to give you another perspective and something to think about, I'm going to show you an example. Just so you know who's talking, my name is Mariska Reinering and I'm a holistic financial planner, helping people reach financial wellness from the inside out. But before we start, I do need to make some disclaimers since this is on video and I don't know the situation of who's listening. So first of all, this is not financial advice. I don't know your financial situation and the illustration I'll be doing is only meant to be general information. Secondly, this is a great example for people who are still in the accumulation phase of investing and have time on their side. There are different things to consider when you're close to retirement or already retired. And third, I want to be really clear that I'm talking about investing in funds here, not stocks. There's a big difference. Actually, let me quickly clarify the difference between stocks and funds. Just to give you a super simplified explanation of the two, a stock is a tiny piece of one company. For example, if you have a stock in Amazon, you own a tiny portion of Amazon. So if Amazon does well, the value of your investment goes up, and if it doesn't, it goes down. And if it does really poorly and goes bankrupt, you lose all your money. A fund, either a mutual or segregated fund, is a collection of stocks. So there are many different companies in one fund. This means you're much more diversified, and not all your eggs are in one basket. So if one company goes out of business, that's possible, but the chances of all the companies going out of business is slim to none. And also you have somebody managing all these moves, maybe from one stock to another, and it's not up to you. So the risk is spread out more. Now back to our example. So let's say I have two funds for you today, Fund A and Fund B, and I have a crystal ball. So I can predict to you that Fund A will have a 25% rate of return and Fund B will have a 0% rate of return. And you'll be investing $100 a month. So I'll show you this over 4 months just to keep it simple and short. So which fund would you pick, Fund A or Fund B? You're like most people, you'd pick Fund A, right? I see this in my workshops all the time. So let's see how this plays out then. So here we have Fund A, and here we have Fund B, and we're putting in $100 a month. Now funds are sold in units, and 1 unit is a proportionate amount of the whole fund. So for this example, think of it as a can of soup. That's 1 unit. And to start with, a unit costs $10. So you're investing $100 and you can buy 10 units, 10 cans of soup. You with me? Then the next month, the value has now increased to $12.50 per unit. So now your $100 buys 8 units, which is $100 divided by $12.50. Again, think of being in the store with a $100 bill and you're buying cans of soup. The next month, it goes up to $20 a unit. So now you can buy 5 units. And the last month, it's $25 a unit, so I can buy 4 units. Make sense? So you now have 27 units. They're worth $25 each. So your total investment is worth $675. You've invested 4 times 100, so you've gone up quite a bit, which is great, right? Now let's see what happens if you had chosen Fund B. So we're starting again with $10 per unit, which gets you 10 units. The second month, it's now dropped to $5. So you can buy 20 units, which is 100 divided by 5. Then the month after, the market has really dropped, just like it did recently in 2008. And the fund is now worth $250 per unit. So you can buy 40 units. 40 times 250 is 100. You still with me? Then the last month, it's back to $10 a unit, so you can buy 10 units. This means that you now have 80 units worth $10 each, so your total investment is now worth $800. Surprised? Probably, right? because this is so counterintuitive. You would expect to make more money with Fund A. When we feel like panicking when the market drops, yet if we're really talking about cans of soup, we'd be excited and stock up when it goes on sale. So there's a few things to point out here. First of all, these are fictional funds. There is no fund that goes straight up like Fund A. But there are lots of funds like Fund B. We see this all the time, and the market does this all the time too, this all going up and down. The key is to stay invested. Often what people do is panic when it's, say, between $5 and $2.50 in our example. So they sell when it's low, and then they miss the whole upswing and get back in the market when it's safe and it's, say, back to $10 or higher. So they've missed out on a huge opportunity. And remember, I'm talking here about people who still have lots of time for this money to be invested. Time to wait for the market to do its thing and recover. There's one more thing I want to point out. Many people feel that investing in the market is scary and that it's much safer, or even totally safe, to invest in a GIC or a high interest savings account at the bank. So let's see what that looks like. You see how that's totally flatlines? You would have hardly any gains. And if you're talking about long-term savings, say for retirement, you really can't afford not to be invested in the market. And if you look at inflation being at 1.52%, you're actually losing money over time, or rather losing buying power by investing in GICs or high interest savings account. But as I mentioned in the beginning, everybody's situation is different, and there are times when GICs and high interest savings account may be handy, necessary, but there are ways to invest in the market and still have some guarantees as well and have a safety net. So what's the moral of the story? First of all, not all is as it seems. Our emotions can fool us, and the math is there to neutralize our fears a little bit. Also, people often talk about timing the market. That's really tricky to do, because by the time we hear about market movements, we're already too late. We've missed the boat. But by investing consistently, we can still benefit a lot from the market ups and downs. Next, you can't really afford not to take some risk, especially if you're younger. It's going to be almost impossible to reach your savings goals for retirement at a 1% rate of return. And if you really want to see the impact of this, you can watch my video on the Rule of 72. Also, you can apply the same principle to lump sum investments. It's just slightly modified. And you can ask me about this if that applies to you. And last but not least, it's really important to work with a financial advisor who understands this and helps you manage your emotions as well as your money. You want to be able to sleep well at night while knowing you're on the right track and you're making your money work for you. So if you have any questions about this, please feel free to reach out to us via email, Facebook, or phone. And I look forward to seeing you in the next video. And in the meantime, be well. You're worth it.